The warning signs are flashing, again. But this time it's not inflation, not unemployment, not debt. It's something more dangerous, more unpredictable. The stock market is like a tightrope right now, balancing between soft landings and sudden crashes. And if you've seen the signals, if you've looked at that chart showing the next huge drop, then you know what's coming might not be an accident. Because behind the scenes, there's a strategy unfolding, a plan that looks chaotic on the surface, but underneath, it's deliberate and planned. And the name attached to it? Trump. He's not just stirring up controversy, he's pulling the levers of market fear. And the scary part is, it's working, from pressuring the Federal Reserve to shaking up global alliances, threatening shutdowns, and undermining institutions. They're part of a five-step playbook, a playbook of chaos as control. The Oracle of Omaha, the man who made billions betting on fear, and unusually quiet right now. But if you study what he's buying, and more importantly what he's not, you start to see the bigger picture. Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." Well, the tide is pulling back, fast, and if Trump's next move accelerates the market's unraveling, most investors won't be ready. But you can be. Because in this video, I am breaking down the 5 chaos triggers Trump could use to intentionally crash the market, and what Buffett's actions tell us about how to survive, and even profit. And no, this isn't some sky-is-falling doom prophecy, it's about seeing patterns, knowing the playbook, and understanding how chaos, when it's calculated, can become the most powerful and dangerous tool in politics. So I am not here to fearmonger. I am here to decode the map and prepare. First, let's look into the Fed, man, and why Trump's pressure on interest rates might be the first domino in a long line ready to fall. The chaos trigger number 1, undermining the Fed to force rate cuts. Trump's feud with the Federal Reserve isn't new, but this time it's more strategic. He's not just venting frustration about interest rates, he's setting the stage for a deeper disruption. In recent weeks, he's reignited attacks on Fed Chair Jerome Powell, calling him Mr. Too Late, and behind closed doors reportedly asked GOP lawmakers if he should fire him. Trump even wrote to Powell saying, "You cost the USA a fortune," by refusing to slash rates further. And now, he's openly suggesting he'd replace Powell with someone more aligned to his agenda if reelected. Someone who will do the right thing, which in Trump's world means cutting rates fast and deep. That idea alone, putting political pressure on the Fed, sends shivers down Wall Street's spine. Central banks rely on independence to anchor market stability. If investors start believing rate decisions are based on political campaigning instead of economic conditions, it breaks a core pillar of trust in the financial system. Already, some signs are emerging. Long-term Treasury yields have ticked higher in response to rumors that Powell could be replaced. Big banks, including JP Morgan, have warned that interfering with the Fed's autonomy could damage global confidence in the US dollar and Treasury bonds, 2 of the safest assets on the planet. Even whispers of this kind of meddling are enough to shake investors. But Trump's pressure isn't just rhetorical. It's a full-blown strategic push. His team is building a narrative. They've raised questions about the Fed's $2.5 billion renovation project, calling for probes and hinting at financial misconduct. It's a convenient frame. Paint Powell as both ineffective and corrupt, then justify his removal. The real motive, of course, is about control. Control over the most powerful economic lever in the country. And here's where Warren Buffett comes in. Buffett has always said that interest rates are like gravity for the markets. The lower they go, the more everything floats, often beyond its real value. Ultra-low rates create bubbles. Bubbles distort judgment, and Buffett doesn't play in that world. He's avoided over-leveraged assets, stayed liquid, and positioned Berkshire Hathaway in ways that speak louder than any headline. He always says that their best deals come when people are panicking. And right now, he's holding record levels of Treasury bills and cash. Buffett understands that artificial rate cuts might give markets a sugar high, but that kind of high usually crashes hard. If Trump installs loyalists in the Fed and forces rates down for political optics, the result could be an overheated economy, sticky inflation, and a stock market pushed into dangerous territory. And when that artificial stability unravels, it won't be slow. It'll be a rush to the exits. What makes this all more dangerous is how subtle it looks. To most people, it's just headlines and partisan squabbles. But if the Fed bends under pressure and cheap money floods the system again, the distortions could be worse than anything we saw post-COVID. The system may not break immediately, but it will bend. And investors who don't see it coming will be the ones most exposed when the tension finally snaps. And if shaking the Fed wasn't enough, Trump's next move might go even further, this time beyond U.S. borders, because the markets don't just depend on domestic policy, they rely on global trust, and that's where NATO comes in. The chaos trigger number 2, threatening NATO and global alliances. Just as Trump eyes the Fed, he's also rattling the world stage. Recently, he's taken aim at NATO, saying allies must pay up or they don't get it. That's not a casual campaign quip. It's a public signal that the U.S. might abandon its treaty obligations if partner nations don't increase defense spending. Later on, he even refused to rule out withdrawal entirely. That kind of uncertainty isn't a minor headwind. It's a gale tearing apart investor confidence worldwide. Let's be honest, markets hate unpredictability. Traders, asset managers, pension funds, they all rely on a stable geopolitical backdrop. Take defense stocks, for example. When a president suddenly threatens key alliances, defense firms temporarily spike on perceived demand. But beyond that, energy markets wobble, forex traders hit pause, and multinational corporations hesitate to invest overseas. It gets messy fast. That's the kind of ripple Trump is creating. Headlines like "Trump threatens NATO exit over unpaid dues" have already circulated, and investors aren't shrugging, they're shifting fund flows. Wall Street is vigilant. Following Trump's NATO remarks, Reuters reported a surge in market jitters, with spikes in volatility as traders scrambled to reassess geopolitical risk. Financial desks tell a consistent story. Fund flows are drifting towards safe haven assets, and pricing models are being tweaked to factor in rising uncertainty. This isn't abstract, it's real cash moving in real time, and strategy teams are taking notice. Buffett has said, "Chaos shakes confidence, and confidence runs markets." He's long watched how global tensions can create short-term opportunities, but also structural risks if left unchecked. He sees that when governments play loose with alliances, it chips away at the assumptions underpinning global commerce. A weakening NATO could embolden conflicts, slow down trade deals, and fracture supply chains, turning business models upside down. And Buffett isn't the type to ignore systemic cracks. He moved into Japanese trading firms, insurance giants, and companies with global reach, but only if they offered predictable cash flows and management integrity. His quiet defense bets aren't an all-in on war, they're a hedge against instability. He's positioning Berkshire to absorb shocks, not speculate on them. But here's the catch. If Trump's alliance threats spiral, the real hit won't be limited to defense. It'll leak into global markets. Imagine Europe struggling to respond, Asia recalibrating security partnerships, and businesses holding off on expansion. That's slowing GDP, weakening earnings across the board, and forcing funds into uncertainty premiums. And uncertainty premiums mean lower stock valuations, even here at home. This isn't abstract fear, it's real money. And while headlines about NATO may not dominate nightly news, they're becoming key data points in boardrooms and portfolio reviews. Analysts are adjusting cost of capital assumptions and recalibrating risk models. That ripple, it reaches bank loans, corporate bonds, and even your retirement plan. So yes, Trump's NATO posture isn't just bluster. It's a calculated push to flip geopolitical stability on its head, and Biden-era assurances are no longer enough to calm markets. Next, we shift closer to home. While global instability unsettles investors, Trump has also been chipping away at U.S. institutions, another move in the same broader strategy. Let's connect those dots next. The chaos trigger number 3, attacking U.S. institutions and elections. Trump's efforts to destabilize confidence aren't limited to central banks or world alliances. They're also hitting right at the heart of America's institutions. He's spent the past year relentlessly questioning the legitimacy of U.S. courts, the Justice Department, FBI investigations, and even the integrity of federal elections. His recent claim that the system's rigged and that the FBI is a weapon spooked markets and rattled civic trust. That kind of talk can move money. Why does this matter to you? Because investment confidence doesn't grow in ground soaked by doubt. It thrives on stability, on the belief that contracts are honored, audits are real, and that ballots count. When investors start wondering if the rules of the game might change mid-play, they start pulling back. Here's a flashpoint. When Trump sparked the Department of Justice to open investigations into election systems just days before key midterms, markets wobbled. The S&P 500 dipped slightly in the following week, as corporate legal teams scrambled to reassess risk. Legal uncertainties ended up translated into financial ones. Investors began pulling money out of state-level municipal bonds because if the DOJ and courts are in question, who's to say what's enforceable? Buffett. He's all in on trusting the American system, but only when it's working. He sees what happens when belief fades. It's not a single headline. It's a slow drip eroding the foundation. And once trust weakens, the impact spreads deeper than fines or policy changes. The immediate fallout? Investors began shifting toward perceived safe havens almost immediately. According to MarketWatch, net inflows into fixed income ETFs skyrocketed by 70% in the week following Trump's DOJ remarks, amounting to roughly $5.3 billion moving into Treasury-focused funds. That's a powerful signal. When institutions sense legal or political instability, they move money into what feels safest, U.S. Treasuries. At the same time, broad equity indexes experienced a gentle pullback. Sectors tied to legal compliance and government contracts, such as financial services, felt a sharper tug. Companies dependent on federal contracts started seeing their credit spreads widen slightly. Investors were beginning to price in added risk tied to government interference. In short, even if stocks didn't plunge en masse, the undercurrents of unease were already shifting asset allocations and signaling markets are attuned to more than just interest rates or inflation. When democratic trust becomes political fodder, markets don't just stumble. They'll recalibrate the baseline expectations for risk. And with Trump actively undermining election results and the legitimacy of judicial rulings, investors are pricing in a higher political risk premium. Even a slight rise in that premium can shave billions off valuations. This all connects back to Trump's bigger playbook. By chipping away at domestic institutions, he's adding another layer to the chaos. It's not just global or economic unpredictability. It's legal and civic instability at home. Next, the series of triggers moves to fiscal brinkmanship, where Washington's shutdowns and debt fights escalate the chaos even further. And that too ties back to building a stage for pressure and staying in control. The chaos trigger number 4, weaponizing government shutdowns and debt fights. While Trump zeroes in on the Fed and global alliances, he's also fortified his next move at home, using budget shutdowns and debt fights as tools of political pressure. In December 2024, he publicly urged House Republicans to block a bipartisan stopgap spending bill, warning that a government shutdown could happen if they didn't veto what he called Democrat giveaways. The bill failed in the House, threatening furloughs and drawing headlines about disrupted holiday travel. It wasn't just political theater. It rattled markets and investors. Now, with Republicans holding razor-thin control, that shutdown specter is looming again in mid-2025, and every payroll report, TSA wait time, or GDP forecast could spark fresh market unease. Even Reuters has flagged the mounting tension here in Washington. This isn't hypothetical. It's real, and it builds the next powerful act in Trump's chaotic playbook. But Trump's strategy doesn't stop at occasional shutdowns. He's also weaponizing the debt ceiling, turning it into an economic pressure point. Treasury Secretary Scott Bessent flagged July as the X date, when the government could run out of money to pay its bills unless Congress acts. Meanwhile, credit rating agencies like Fitch are explicitly warning that a stalemate could follow, stressing that a unified government under Trump and a narrow House majority could lead to prolonged gridlock. Imagine the stakes. A Treasury bond default, no matter how brief, could unsettle global faith in U.S. credit and unleash panic across global markets. History shows it only takes the threat of a shutdown or default to upend investor confidence. Back in 2011, the U.S. credit rating was downgraded the first time after a debt standoff, triggering a sudden plunge in stocks. Fast forward to now. Fitch flagged an increase in swap spreads, indicating a growing fear that even short-term debt might default. Wall Street models are reacting, pricing in higher yields just in case politicians can't sort things out. Buffett's posture says it all. Berkshire Hathaway is holding record amounts of cash and short-term treasuries, not because he expects free money, but because he expects turbulence. Buffett's playbook stays consistent. Don't overpay for risk. If he senses political gridlock might slam into credit markets, he's fine holding liquidity until clarity returns. Here's why that matters. Trump's shutdown and debt ceiling gambit are building deliberate pressure. If the government temporarily stops paying federal salaries, shuts national parks, or suspends parts of social spending, that's not only a public inconvenience, it hits GDP. Goldman Sachs estimated a short shutdown cuts a couple of tenths of a % off quarterly growth. But a longer budget fight? That could dent consumer sentiment significantly. Then add the global credit risk. If U.S. bonds aren't trusted, the dollar weakens, borrowing costs spike across the board, and emerging markets begin to bail. Suddenly, the entire financial ecosystem gets dragged into uncertainty. And that's precisely what Trump's team seems to be counting on, a self-amplifying cycle of card plays. Create the crisis, stoke the fear, appear as the resolution. So when you're watching debt ceiling deadlines flash on your calendar, remember, this isn't just DC political theater. It's one more domino in Trump's 5-part plan to destabilize and then control the market. Next, we'll connect how all this chaos feeds into the final piece, his broader strategy of chaos as leverage for power. The chaos trigger number 5, chaos as leverage for power. Trump's strategy unfolds like a carefully orchestrated play. He layers shock upon shock, first rattling the Fed, then international allies, next domestic institutions, and finally flexing fiscal power. But all roads in this strategy lead to the same place, chaos. And chaos, for Trump, is power. It's the final act of his 5-step playbook, and a move that could shake markets harder than anything before. Here's how it works. Trump creates a crisis. The headlines erupt, investors freeze or flee, and then he steps in as the only one with an answer. Nearly every one of his major announcements lately fits this pattern. He'd threaten to fire the Fed chair and immediately follow it with a promise to control runaway markets. He'd raise alarms about NATO and then speak as if only he can restore global order. The point isn't the turmoil, it's the solution narrative that follows. For investors, this kind of turmoil is unpredictable, and markets truly hate the unpredictable. Volatility creeps up, sell-offs ripple through portfolios, sentiment turns sour, and smart money starts to step back. That's exactly when generational wealth changes hands, when fear feeds reset. What's crucial is that this chaos as control cycle doesn't rely on external shocks. It uses internal leverage, and that's scarier. A fuel tanker crash might tank oil, but it's random. This is purpose-built. When every lever in Washington can be used to fuel fear, markets become a high wire with no net below. For investors, that raises the stakes. You have to decide. Ride the wave of momentum or stand firm and wait for the reset. Now, after Trump triggers this chaos, the big question won't be if the market crashes. It will be when and how badly. And then the real test begins. Will you be caught in the panic, or will you be ready to step forward? So here's the big picture. Trump's 5-step strategy isn't random. It's a calculated blueprint. He's rattling the Fed, rocking global alliances, undermining U.S. institutions, weaponizing government funding, and using chaos as power. When you connect the dots, it becomes clear. This isn't drama. It's a deliberate game plan. And yes, it could trigger the next huge drop you've already seen shaping up on the charts. But while that might sound alarming, there's a silver lining if you know what Buffett does next. Warren Buffett isn't a gambler. He doesn't try to predict the exact moment the market will crash. Instead, he watches and waits. He keeps liquidity ready. And when clarity emerges, when headlines stop rattling, when chaos settles, he deploys his capital with surgical precision. That means you can too. Here's how to benefit from the chaos without getting burned. First, embrace preparedness. Buffett currently holds a record pile of cash and treasury bills. That gives him optionality to swoop in when good businesses are on sale. You don't need Berkshire-sized reserves, but aim for 10 to 20% liquidity. Not tied up in speculation, but ready to move when prices drop. Second, invest in companies with real economic moats, like consumer staples, solid banks, or insurance firms, especially those that don't rely on Washington waves to stay afloat. These businesses can weather short-term political storms and still thrive long-term. Third, lean on broad market vehicles. Index funds give you exposure to the whole market without needing to pick winners. They'll dip, yes, but when panic fades and markets settle, they come roaring back. That's Buffett's core approach. Own a piece of America's future and hold tight. Fourth, ignore the noise. Trump's quota of shocks? They'll grab headlines. They'll rattle your nerves, but do not trade on turns of phrase. Instead, focus on cash flows, balance sheets, and long-term earning power. That's the bedrock. Last, act with timing, not timing the market. Don't hold off forever waiting to time the bottom. You'll miss the rebound. Set targets. If a quality stock drops 20%, move in. If the index slumps 15%, consider gradually buying. Be systematic, not emotional. This isn't doom or gloom. It's clarity. Because when chaos lands and when Trump's strategy unfolds, you'll have a blueprint. Want to know what Congress is buying in all this? Click the video on screen to find out